Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro. Hello, fellow investors. Welcome to Seven Bulls Capital Research. Today, we're getting into market crashes. Now, this isn't about fear mongering, it's actually about empowerment. Before we move on, if you find value in today's video, make sure to give it a like and share. Also, watch until the end and leave a comment. It helps us grow the channel. Thank you. Now let's get to it. So, nobody enjoys watching their investments take a hit. But the truth is, market crashes are a natural part of the economic cycle. They've happened before and they'll happen again. It's like the weather, you can't prevent a storm from coming, but you can prepare for it. And with the right strategies, you can not only survive a crash, but potentially even use it to your advantage. What is a market crash? It's a sudden decline in stock prices across a major market index like the S&P 500. It's a period of intense fear and uncertainty where logic often takes a backseat to emotion. But here's the fascinating part. The very structure of the market is, in a way, designed to capitalize on these emotions. Think about it. The constant pressure to buy and sell, the 24/7 news cycle with its alarming headlines, the herd mentality that can sweep through the investing world. History is filled with examples of this: the Great Depression, Black Monday, the dot-com bubble, the 2008 financial crisis. These weren't just economic events, they were psychological ones. Fear and panic led to mass sell-offs, creating a self-fulfilling prophecy of decline. But here's the key takeaway: successful investing isn't just about understanding the numbers, it's about understanding human behavior. It's about recognizing the inherent irrationality of the market and finding opportunities where others are driven by fear. So, how do you stay afloat when the market feels like it's capsizing? First and foremost, build a diversified portfolio. Think of it as your financial ark designed to weather any storm. Don't put all your eggs in one basket. Only keep a concentrated portfolio if you understand the companies that you're holding. Now let's reinforce that arc with some defensive strategies. Value stocks, for example, are like the anchors of your portfolio. These are companies with strong fundamentals, a history of paying dividends, and a proven track record of weathering economic storms. They often hold up better during downturns because their value is rooted in tangible assets and consistent earnings. And speaking of safe havens, let's not forget about gold. Throughout history, gold has been a reliable store of value during times of economic uncertainty. And just as important as any investment strategy is having a solid cash reserve. Think of it as your emergency fund, enough to cover 3 to 6 months of living expenses. It's your financial life raft, giving you the flexibility to ride out the downturn without being forced to sell your investments at a loss. Here's the silver lining of a market crash: it creates opportunities. While everyone else is panicking and selling low, you have the chance to buy low and position yourself for future gains. Think of it like a Black Friday sale on Wall Street. Look for sectors that tend to be more resilient during downturns. Healthcare, for example. People still need medical care, regardless of the economy. Consumer staples, the essential goods like food and household products, also tend to hold up well. Utilities, which provide essential services like electricity and water, are another area to consider. This is where value investing truly shines. Legendary investor Warren Buffett built his empire by finding undervalued companies with solid long-term potential. A market crash often reveals these hidden gems, companies with strong fundamentals that have been unfairly punished by the market's pessimism. Investing during a market crash is as much a mental game as it is a financial one. Fear and greed are your biggest enemies. The news cycle, social media, and even well meaning friends and family can amplify these emotions, leading to irrational decisions. Don't get swept up in the herd mentality. The market is driven by emotions in the short term, but fundamentals in the long term. Focus on your long term goals. Remind yourself that market crashes are temporary setbacks. History has shown time and again that the market recovers, and it will again. Building a resilient portfolio is an ongoing process. It's about having the right tools and knowing how to use them. Regularly monitor your investments and rebalance your portfolio to ensure you're still on track with your target asset allocation. Stick to your plan. Emotions can lead to impulsive decisions that derail your long term strategy. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell. Keep up with your financial education. You're the only one in charge of your future. Be safe.
We grew.